Welcome to Retire Smart with David Brooks. I'm Chip Maxwell. David, first order of business, it is the last call for ABCs of Medicare. I know you're going to go in detail on that in the second segment of the show today, but Thursday night, March 30th, 6:30 p.m., right here in the Midwest Learning Center at Retire Smart. That's 402-369-7777. Now, don't wait. These fill up quickly. David, maybe just a quick synopsis of what people can expect in the workshop.
Yeah, so what we have is Dustin Galvin usually teaches this class, and he kind of just goes through basically understanding how Medicare works. There are four main components to Medicare, and it's really critical that you understand how each component works, where your exposure lies, you as the consumer. What are you expected to pay? What does the government pay? And how you can make sure the choices you make sure you're protected as you want to be. And there's some people need to pay more upfront or out of pocket in some situations. Some people can pay little or nothing out of pocket. But those decisions you need to really factor in your total cost in healthcare in retirement. And it's the M in our SMART plan. It's critical that people understand the medical and healthcare expenditures. It's the second largest expense, Chip, people have in a retirement plan.
402-369-7777. No charge, no obligation, the ABCs of Medicare. David, I'm giving the number out right now and urging people to call because we just had a Social Security workshop. Actually, we had to schedule an extra session because the first one filled up so quickly. Another success for Sean Swanson in his Social Security presentation.
Yeah, the Social Security Blueprint was really well received. And so, yeah, we had to actually had another whole class. And the great thing is the Midwest Learning Center, the whole reason we developed this educational content for adults in particular is we just don't teach financial literacy really in this country. I mean, at any age, really, unless you go get an economics degree or a finance major, you're kind of just left to figure this stuff out. And so we've developed a series of classes. We have a ton of them, folks. You can go to our website, retiresmartomaha.com, and find out when future ones are coming. But yeah, we had to do a whole extra class on the Social Security. It's become very popular. We do have upcoming classes on the smart insurance, estate planning, et cetera. So when you hear about this, I would tell you they do fill up. Like this one we just did this last week. We ended up having to do a second class, and we were really grateful for those that were able to accommodate that were even willing to move to a different date, because we had so many people subscribe to it in just like 1 or 2 days. So it's just awesome to see, and we love doing this and giving back to the community with the education. So and these are all complimentary. So
no charge, no obligation. ABCs of Medicare, 402-369-7777. We'll go in more detail in the second segment of the program. But in the meantime, David, on to the news. At a recent team meeting here at Retire Smart, you noted that the Federal Reserve made some unprecedented moves, not necessarily for the better, though, David. For example, one comment you make is that they're adding fuel to the fire when it comes to inflation.
Well, yeah. So the Fed has been trying to unwind their balance sheet, which got up to $9 trillion. People need to understand the scope. If you go back historically, and I showed you guys in the meeting, historically, the balance sheet was about $700 million. It was just enough for banks to come in and trade in cash for securities, et cetera. It operated as a discount window if a bank just needed to shore up deposit numbers overnight, et cetera. But we're carrying this insane balance. And so for the last 18 months, they've actually been trying to trim that balance down and been lightening the load. Well, I also put a chart up when I was doing some advisor training this week and showed them, well, all that was just a joke because in 1 week, they added $310 billion back to their balance sheet. So are they serious about fighting inflation? I guess not, right? Because this is the very fuel to that fire fighting inflation. And the Fed kind of was in a rock and a hard spot this week on raising rates, chicken little move, if you will. But now we're going to be fighting inflation even longer than we thought. They should have let one of those banks fail, in particular SVB. I'm talking about Silicon Valley Bank, in my opinion. And there would have been some carnage for sure. But now, and then you have, and I sent you an article, you now have Janet Yellen, oh, we can backstop all the banks we want, basically. No, you can't. There's so much stuff on these balance sheets of these banks, and the one we're talking about, SVB, they didn't have a risk management officer. How are they allowed to operate? What kind of oversight's going on? What happened to Barney Frank, Mr. Frank Dodd, who was on the board of Signature Bank, one of the failed banks in the last 2 weeks?
Well, and when you reward and accommodate that kind of behavior, you're going to get more of it.
And that's the problem. Well, there's going to be more carnage coming and more banks will be disappearing,
Actually, David, I have that article that you sent me. The CNBC headline is Treasury Secretary Yellen says the government could backstop more deposits if necessary to stop contagion. But we need to clarify here. Now, there is the Federal Deposit Insurance Corporation. The FDIC covers deposits up to what, 250,000? So there is that automatic, but she's talking about going beyond that, right?
Yeah, and then you got all kinds of proposals like we'll just backstop any amount. How? How are you going to do that? Now, if you want to do it at some cost, so in other words, because just so you understand, the banks all pay a basically into the insurance program, the FDIC, a percentage of some of the earnings they make as a bank to fund that 250 guarantee. So if they're really going to guarantee higher, then that does come at cost. They're basically got to buy insurance, right? And so who's going to pay for that? You or the bank? Well, I would say
that's going to come out of your pocket.
Of course
it
is.
Joe and Jane taxpayers.
So when the last round of major banking regulation, which was known as Frank Dodd, okay, two senators no longer there, they passed this major legislation, then both get out of there before their next election. But anyway, and Chris Dodd we're talking about, and Barney Frank. So the average compliance cost went up about $67 per checking account. Okay, so you know your free checking you think you may have, or supposedly free. Is it really free? Well, it might be free to you if you operate, cleanly in your checking account. But the average NSF, like non-sufficient funds fee, has more than doubled since that legislation passed. So in other words, they have to get the fees back to pay for the compliance and regulatory environment. And if they raise these limits, that's going to increase it even more. And so you're either going to be paying like $29 a month for your checking account, or they're going to really wallop, unfortunately, those that do bounce a check occasionally or something like that. It'll be a $100 fee or something because the bank has to get the revenue from somewhere. This is not a good idea. Folks, if you've got more than $250,000 in an account, and let's explain that real quick. Chip, it's based on your Social Security number and the titling of your account. So you, Chip, can have $250,000 in a checking account at Bank A, and you're covered, right? Your wife could also have a checking account there, get $250,000 in her name. Now you got $500,000 covered. You can then have a joint account and have $750,000 covered. So understanding how to use the rules, not many Americans need to worry about coverage over $750,000 in their checking account, I don't think. If you've got more than that, and a lot of our clients do, then your money shouldn't be in the bank. We can put in a treasury management portfolio here. There are other alternatives. And we're not the only one, but I'm just saying you need to get educated on this stuff. And if you're sitting on a pile of cash out there, you need to learn what you can be doing. And the good news is at least those treasuries, very short-term instruments like T-bills, are paying north of 4% right now, and in 4-week maturities, no less. So you can earn some cash and you can get it out of the bank if you're nervous, But most people, this is not going to be a problem. If you're under $250,000, you have nothing to worry about. Now, the problem we all have to worry about is if they do change the limits, who's going to pay for it? And again, I say that's you and I as the consumer.
David, back to the team meeting recently, and I'm going to issue a jargon alert now, but that's one of the things you do is break this down and put it into plain language for us. You noted that we are shifting from a policy of quantitative tightening to quantitative easing. That is jargon to hide what, David?
So basically, when the government's spending money, right? So we make loose monetary policy. The Fed was doing what we call QE, quantitative easing. We've been doing this basically for 15 years. And finally, after they lied 2 years ago, transitory inflation, they realized, oh, we caused this. We should probably start to tighten it up. And so they flipped from an easing stance to a tightening stance. But they did that in the fastest in raising interest rate environment in our history, racking up 8 interest rate hikes in a 13-month period, and they're creating some breakage, right? And that's the bank issue. So instead of just following through and letting the breakage happen, which is really what they should let happen, we just went the reverse and this went, like I said, added $310 billion in a week. And now they're easing, putting loose monetary policy, which means inflation will not be getting to its target anytime soon.
It also did not look, David, like the Fed. You recommended that the Fed should just rip the Band-Aid off, raise the interest rates, 150 basis points, and be done with that and let everyone adjust to the shock wave and move forward. But you said it looks like the Fed's getting cold feet. It's becoming reluctant to do anything like that.
Yeah, now they're slowing. And the longer they take this interest rate hiking cycle, the less efficacious each hike is, right? And historically speaking, we don't pivot. And we've talked about this many times. People keep calling, they're going to pivot and go the other way. The last 7 times that the Fed went through a cycle change from raising rates to declining, there was an average pause of 7 months in between the last hike and then when they start taking them down. That was average. Now, this time it might be a little shorter. It might be 4 months, but they have to wait for a period of time to see the lagging data if what they've done has been effective. And so, like I said, if they would have just ripped the Band-Aid off, they'd get the carnage over with a little earlier. But the pain is coming. And so take heed, understand that Wall Street is going to go through a recession, profit recession, which is most likely going to lead to lower equity prices, and you should just be prepared for that. So people should take heed and get maybe a risk analysis. That is the R in our proprietary smart planning process, and we will do that for you complimentary. If you'd like to get a risk analysis, just let us know.
David, another CNBC headline: wholesale prices post unexpected decline of 0.1% in February. Retail sales fall. Are we starting to see what everyone's been warning about that 2023 might deal us?
Absolutely. So we talked about this at our State of the Market. Like, inflation is still a problem, but we've gone past the peak now. It's still going to be here, but you're going to start to see deflation creep into other areas. And the PPI surprised Wall Street. They were expecting a 0.3 increase, and they got a negative 0.1.
It's the producer price index, right? It's what the businesses are paying, the wholesale
the cost
rates
of producing goods
before
and
they
services.
turn around and sell it to you, the customer.
So CPI came in still at 6%. There was no relief there. The PPI did have a little relief, but again, this is showing you that companies are struggling now to even put together the products that they're selling, and you're going to see discounts, and you're going to see companies that are not really strong on their balance sheets are really going to start to suffer, and it's going to show. And you're going to see this, and you'll see lots of mergers or takeovers happen in the developed economic world, because those that have sound balance sheets will come out of this ahead. Just like in the banking industry, unfortunately, right now the little guys really getting torn apart here. Small banks are going to really suffer, and the large four, the big four, which is Wells Fargo, Citigroup, Bank of America, and J.P. Morgan Chase, they're coming out shining like a rose to this because everybody's flocking to the big $3 trillion plus basically banks.
We're hitting the rough waters. We're moving into the turbulence. Don't panic. Contact us, 402-369-7777, for a complimentary report card. We'll review your whole financial situation. Maybe you're in good shape. Maybe you need to make a few changes. Now is the time to find out. No charge, no obligation. 402-369-7777 for a complimentary report card. 402-369-7777. Up next, from the halls of Montezuma to the fourth floor at the Valmont Plaza. He was a United States Marine. He's now a financial advisor at Retire Smart. We'll check in next with financial advisor Dustin Galvin on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Our special guest this week was in the Marine Corps. His mission now is to help people optimize their quality of life in retirement. David, please introduce our special guest.
Thank you, Chip. Yeah, hey, we've got our favorite ex-Marine here, former Marine, sorry. I guess you put it politely, right? My dad, of course, is a Marine, Semper Fi. But we want to talk about having Dustin Galvin, one of our advisors, back in studio this week, and we're going to talk a little bit about Medicare because, one, you've got a class coming up, right?
Yeah, next week, Thursday at 6:30.
All right, awesome. And first of all, thanks, Dustin, for taking time to stop in here. I know you've got a very busy calendar this week. Appreciate you taking a few minutes to speak with us on Medicare. But you had added some new information to the class that you've been teaching. It's been very well received. But you were talking about how was it RBC or one of the big institutions had written some kind of a white paper, and we'll see if we can't find the link to put it to the show. But on how much of our population will actually be on Medicare in a very short period of time.
Yeah, so there's two different articles that I found. The first one was by RBC Wealth. By about 2034, we will have 77 million Americans on Medicare. And by 2026, we're actually going to stress our Medicare trust fund level. At that point in time, we're going to have about 20% of our population on Medicare. And
so 20% of the population in basically a decade will be on the government's rolls for healthcare.
Mm-hmm.
That's kind of scary for a lot of reasons, right? Now, one, look, Medicare is a pretty good program all in all, and there's parts of it. In fact, Part D is still the only official government program of this magnitude launch that's still under budget to this day, which the Part D was, as most people know, was brought about under Bush Jr. W. Back in 2004, and that's the drug coverage portion of it. However, our current administration, I think, is blowing that up by changing the rules. But anyway, that's a story for another day. So 20%, so 1 out of 5 Americans is going to be needing the government via Medicare to give them their health care.
You're right, David. There's going to be about 1 in 5 Americans on Medicare, and there's going to be a few ways that they're going to have to make sure that this trust fund for Medicare doesn't run out. A few things that can happen is the first, government slows down on spending, which I think we both agree that that's not going to happen. So they're probably going to have to raise our taxes even higher than they're projected to go in 2026.
So, yeah, absolutely. So this is really important because there are politicians, there are people out there that lean towards the socialistic side of government. They want more, healthcare is a right, et cetera, and Medicare for all. We see this a lot around the elections. We should have Medicare for all, and there's certain politicians that champion that. First off, Medicare is not free for the consumer, right? So when you get Medicare, you need to understand you've been paying payroll taxes your entire working career to fund Medicare, but that only covers one part of it, Part A, right? So, and what does Part A cover?
So Part A is only going to cover you when you go into the hospital. Anytime that you need to just go see your doctor, get outpatient treatment, anytime it's not being admitted to the hospital, you're going to have to access Medicare Part B. The problem is Medicare Part B won't cover all those costs.
Right. So basically, it covers about 20% of the or 80% of the cost. You shoulder the burden for about 20% of the out of pocket, and you have to pay a premium to the government. This is the part a lot of people don't understand. Younger people don't realize you pay when you go on Medicare every month if you want to access Part B and Part D, right? And Part B is about $165 a month for the average American today. But a lot of people don't know that could be up to $500 depending on what your income is, right?
Yeah, I see it all the time. Depending on the kind of income that you have in retirement, if you have some really high RMDs or you just have high Social Security.
And so RMDs is required minimum distributions. That's where you're forced to take money out of your retirement accounts, even if you don't want to. Why? So we can create taxable income. But anyway, let's just put that in there. But yeah, so they're forced to pay this. And so some people walk into retirement, they've had good careers, they had good incomes, maybe a dual income family, a husband and a wife, both had good, and they walk into Medicare and like, well, no one told us about this, right? How often do we hear that, right? No one told me.
Yeah, we hear it quite a bit. Everyone's surprised when we kind of take them through our process and show them their Medicare payments. One other thing a lot of people don't catch is the widow's dilemma. We talk about it a lot here at Retire Smart with our clients, but the threshold for Medicare and how much income you can have before you reach those penalties that can get up to $500 is cut in half if you're filing single. So
yeah, so if you're a divorcee, a widow or widower, or just single and never got married, you need to really, really be paying attention to these thresholds because you very quickly have to start paying penalties. And so this isn't just you're jumping to another tax bracket, which is a problem in itself. You're having to pay more to access Medicare. And then the other problem is the reality, as you mentioned, with the trust fund being stressed here in just 3 years, they are going to have to start making your out-of-pocket expenses higher, right? There's a reality to that. So you're going to be getting more fees, more co-payments, higher percentages. They're going to have to change the calculations or it's insolvent.
right, and I don't think they're going to let it go insolvent. But the easiest way for them to solve this problem and what we foresee happening is higher taxes, higher premiums that you'll have to pay to access Part B and D, or even maybe an age increase. That's something else that I found in that article.
Now, don't despair, folks. There are strategies you can put in place, even for Medicare, to help make sure you understand what your potential out-of-pocket portion is. Even if they raise the premiums, et cetera, we can help you understand how to potentially lower your total out-of-pocket. According to Fidelity, and this is a couple years old now, a married couple turning 65 will spend $315,000 or more out of pocket over and above what Medicare is going to pay for them for their health care in an average retirement. And this does not even include long-term care, right?
That's correct. And that's why it's really important when you're on Medicare A and B that you have a supplemental plan to cover that gap so that you don't get on the hook for a big bill that you weren't expecting in retirement.
So what you're talking about is you can buy private insurance. These are called Medicare supplemental policies, sometimes referred to as Medigap policies, depending on where you live in the country. And you pay a monthly premium, and basically they will cover a good portion, if not all, of the out-of-pocket, depending on what type of supplement you buy. This is the type of information that you're going to cover in depth, right, in the class, the ABCs of Medicare class?
Yeah, so I'm going to go on the whiteboard. I'm actually going to cover traditional Medicare and talk a little bit about Advantage plans. Now, typically, we don't recommend those to our clients.
Well, and that's because most of our clients have means, right? So Advantage plans are perfectly fine for those that did not unfortunately save a lot for retirement. And
Mhm.
so and Dustin will explain all that in the class, but just so you understand, Advantage plans, basically you're removing yourself from the original Medicare A and B, and you're moving to what's called Medicare Part C. And basically, these are primarily managed care plans that are run by an insurance agency, and they sound awesome when you sign
Oh,
up,
yeah.
right? Because most of them,
I
the
got the free
premium
one.
is nothing. Yeah, but it's not free. There's a lot of out-of-pocket exposure there, and they have the right to put premiums on there. And a lot of people find that out here locally. There's a couple of carriers that are here in town that by your third year, all of a sudden your premium's up to $80, $90 a month when it was free, or at least you thought it was in the beginning. So what we're trying to basically get people to understand is get educated before you make the decision. So if you're not yet 65, if you're in your early 60s, this class would be really, really smart for you to attend. And how can they attend that? Do you get the information? When is that class coming up, Dustin?
That class is next Thursday. That's the 30th of March at 6:30. It'll run for about 45 minutes to an hour. And I'm trying to work with David to see if he'll get us some food for the event as well.
So we may have some refreshments there. So if you want to get signed up for the ABCs of Medicare class, just give us a call now at 402-369-7777. Again, 402-369-7777. That's Thursday, March 30th at the Midwest Learning Center, 6:30 p.m. It's about an hour-long class where you'll get quite a bit of information on how the basics work, and then we'll also give you some information on how to follow up to your specific situation so that you can feel confident. And even if you're already on Medicare and you're just curious how the other parts work, or maybe you weren't sure if Advantage was right or supplements were right for you, you can get the information so that when your open enrollment period, which will come up at the end of the year, you'll be educated and can make a proactive and sound decision for you and your family. All right, we're getting about out of time here. Dustin, thank you so much for stopping by this week. We'll look forward to you having an awesome class, and we'll have you back on here shortly to tell us how it went.
Thanks, David.
All right, man. Let's have Chip. Tell me what's going on next.
Up next, you have questions. David Brooks has answers. Q&A is next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Into the Q&A we go, David. First question is about border impact. David, we're still cycling through our questions from the State of the Market event. There was great attendance and great interest in all the things in the news. And here's a question about the impact of what's happening on the border. What will be the financial impact of the open border?
Boy, there's a lot of financial impact for the open border. Now, I don't think anyone can accurately calculate that, honestly, but we do know it comes at a major cost because we're literally they're just letting them through, in unprecedented numbers, millions and millions per year now. And those folks are getting services that are provided by our tax-paying dollars. And look, in general, the problem I have with that is we're not providing the services to those that have either fought for our country, or veterans, or those that are paying taxes are not getting the same access to certain services. And of course, you hear all kinds of stories, and I'm not going to go through all the specifics, but some of these folks are getting put up in some pretty swanky places, and the government's paying the bill for hotels and VRBOs and Airbnbs. I mean, and the amount of money we're spending here is huge. The economic impact is in the trillions, though. I want to make that clear, in the trillions from the open board policy that we've had here in the last couple of years.
What would be some examples?
Well, I mean, so if they're going to suck down off of our welfare state, in other words, start to use up benefits, those are benefits no longer going to somebody who effectively paid for those benefits and can't get them. That means that person is either going to have to go without, or they're going to have to take some of their own capital to get the same benefit, go pay for their health care themselves type of thing, which means they can't spend that money on goods and services maybe they would have otherwise had as discretionary spending, and the ripple effects just keep going down. It's like if you throw a little pebble in a lake, that ripple effect just keeps going wider and wider, and that's the economic damage. Each one of these unintended consequences of this current administration's actions on the border is going to have a ripple effect in the economy in every city in America where one of these migrants shows up, and somebody has to pay for something for them, and so that's less money that would be going into a productive use of money in the economy. And again, look, no one's against people getting health care. These people are coming from countries where they don't have any opportunities, but there is a legal and ethical way to enter our country. It's been that way since day one.
David, in the first segment, you were talking about some action with T-bills, and here's a question about bonds. Very simply, what will bonds do in 2023?
Well, let's go through some history, right? So 2022 was the second worst year in history for bonds. And the last 3-year bonds have basically lost almost 10% collectively over a 3-year period, the aggregate bond market.
They're supposed to be the safe haven in the investing world, but that hasn't been the case recently.
Well, but year to date, there's some positivity in bonds, and we like short term duration stuff right now. So the shorter duration, the safer, in our opinion. However, there's opportunity out on the long end of the curve if you're willing to take on risk. And again, how much risk are you willing to take, Chip? This is a question people have to ask for themselves, because the further you out on what's called duration. So when we say duration, like we could have a T-bill, which is maybe a 90-day bond, right? And it expires in just 90 days. So the time factor is not going to change much, right? Then you could go to like a 2-year or a 5-year or a 10-year or a 20-year or a 30-year. The further you go out, the more the whipsaw in the price action, the more sensitive they're going to be to interest rates. And with the Federal Reserve, if no one's really sure when they're done, going out on that long end of the curve can be risky. This is part of why the banks that failed. They thought the Fed was done back in November, and so they put all their money on the long end of the curve, and then they lost over 10% on those bonds in a very short period of time, and then they had to sell them at a loss. You can lose money in bonds if you sell before maturity. So I don't know what bonds are going to do this year. Do we think there's opportunity? You betcha. But right now, we are currently stanced in the shorter end of the curve, and we will slowly transition that duration out when we think the time is appropriate. But I wouldn't necessarily think that's today.
Back to the topic of inflation, David. In today's market, how do you invest to beat inflation?
Well, over time, right, you have to look at history. You're not going to try and beat inflation 1 quarter, 1 month, or 1 year at a time. If you're gonna benchmark whoever's helping you on that short a time period, then that's probably not a realistic component. So how do we beat inflation? Well, for one, we have to study what inflation is, and 40-year historical inflation is about 3.2% right now. Right, so we know it's much higher. It's around 6% currently. It was even higher in almost at 10%, about a year ago, right? But historically speaking, we ebb and flow inflation. So you want assets that will appreciate over time. Stocks have always been a great asset long term, Chip, long term to outpace inflation. However, if you're looking in the short term, that may not be the case. You can also buy hard assets, right? So hard assets like real estate typically appreciate at the level of inflation, right? So residential houses, we talk about that in some of our classes we teach. I own residential real estate rental properties. They double in value about every 18 years. Well, that's inflation, right? The cost of goods and services double about that same time period. If you're at about 3% inflation, you're going to pay twice. The price is going to double about every 20 years. So hard assets like that can keep up with inflation. And then you can invest in things like I-bonds, but you can only buy $10,000 a person. These are inflation-adjusted bonds from the government, and you can't get those through like a firm like us. You got to buy them yourself. You go to treasurydirect.gov. You can buy those, and you'll get paid based on inflation. But you have to hold them for a period of time, and so you could lose some interest if you don't hold to maturity, et cetera. You can buy what's called Treasury inflation-protected securities, and so there's lots of ways you can manage this. And a lot of times you're not going to beat when inflation is 6-7% like we have now. You may not beat inflation, but you want to mitigate it, right? So right now, like T-bills, as we said, short-term treasuries from the government are paying 4.5% or so. Well, that's at least better than having a money market a year ago at 0.4%, right? So you're not getting as bad a hit on the spending power. And as inflation comes down, you can then put those dollars to work where you think it is appropriate, real estate, equities, what have you. So you've got to understand how you're going to beat inflation is understand your time horizon, your risk tolerance, et cetera. And then what we do is lay out a case of how we would beat that, but we're not going to focus on, did we beat it in the last 30 days? That's you've got to have a realistic time horizon on these things.
David, the next questioner is worried about China. The question is, what if war breaks out with China?
And it's hard to see that actually comes to combat war. I mean, we could see some action with Taiwan. That's certainly a reality. The real problem with that is I don't think the current administration would help put up much of a fight, unfortunately, for Taiwan's sake. But the shipping delays, that strait is where a massive portion of all goods and services from around the world would be held up. And if there was some war that stopped shipping channels for a year, you think the supply disruption from COVID was bad? This would be like 10x that, and so it would be a big disruption.
I'm hoping it would do such damage to China that China wouldn't want to do it. I guess it depends on how political are they in China.
Well, and as I said,
we don't care if it hurts us economically. We want to stick it to the United States.
I've said it before. We're moving in more of a phase similar to the Cold War days against the USSR, et cetera, right? So China is a necessary evil we will deal with. Like Russia sold oil to Europe all through the Cold Wars, right? I mean, countries economically are tied to, like Poland recently just had some statement they're going to give fighters to Ukraine. They're the first one to offer fighters, but they are the second biggest economic exchanger of goods and services with Russia in the European bloc, right? So they say one thing, but they're still tied to each other. And China is tied to us. China imports a lot of our goods. Now, yes, we get a lot of technology, a lot of cheap screens and TVs and products like that, but China looks to us for a lot of innovation as well. And not only that, China gets paid a lot of interest on our debt. They hold quite a bit of it, and they don't want that to go away. If we defaulted on that, if we went to war and said, we're not paying you anymore, I don't know what's going to happen there, but I'm just saying the likelihood that we go to a full-blown war with China is not very high at this juncture. Now, I know depending on where you get your news, there could certainly be some rhetoric going on because China and Russia are coddling up to each other right now. But I just had somebody ask me this week, well, should I put all my money in gold? No. All right. There's a quick answer. But you got to understand that it's never as bad as it seems. It's never as good as it seems, right? And the reality, the truth lies somewhere in the middle. And China needs us just like we need them in the current global economic situation we're in. And so does the rest of the world.
David, here's a question about food shortages. Some economic analysts predict there will be food shortages in 2 years. Do you agree?
I've actually read some of the articles on that, and I don't necessarily think you're going to have. I mean, we have food shortages globally today, right? There's famines in certain countries, et cetera, and there is an issue because Ukraine, going through the war, is a very large supplier of wheat, right? And that the production has been hindered. They are actively producing again. And it's kind of interesting, too, is they are going out the bottom through Crimea to shipping ports. Russia's allowing that again. So while they're fighting, they are economically still working with each other on certain things. So don't believe everything you read. I will tell you, food prices are not going to come down. As you see the government report to you, CPI going lower and lower, and because they put a bigger percentage of that on real estate, you're going to see that drop. But your food prices, I suspect, will be pretty high over the next couple of years. So just be prepared to keep paying a lot of money for your groceries. If you haven't noticed how big that grocery bill, it's going to be more expensive. But I don't think anyone in America with means will not be able to get food, in the current environment. But yes, it's going to be a very different environment.
David, we're out of time for Q&A this week. How many openings do we have this week on the calendar for people who would like to schedule a 15-minute phone conference with one of our advisors?
Unfortunately, we don't have any. Our calendars are that full. So I would tell you, take advantage of the report card if you want. We would love to get you in to show you what's possible. But, you don't know what you don't know.
402-369-7777. That is a complimentary review of your entire situation. 402-369-7777 for the complimentary report card. Up next, the tech wreck continues. More layoffs in the cyber world. We'll tell you about it next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Well, David, in that State of the Market address, you referred to it as the tech wreck, the tech industry being hit with round after round after round of layoffs. Well, the hits keep on coming. Here's a CNBC headline: Amazon to lay off 9,000 more workers in addition to earlier cuts. David, 18,000 in November and now another 9,000. Has it stopped, or do you think it's going to keep going?
No, it's not stopped. It's going to continue. So we've seen several of the big companies announce now their second wave, and this will continue because, listen, some of these jobs were profitless jobs to the company. In other words, they were side projects or, kind of shiny objects, as I sometimes call them here. And I'll put up a project on the side that's not our main thing.
That's a luxury they can't afford anymore.
Correct. And as you go through profit recessions, and these tech companies are going through a lot of transition. Number one, the government's focusing on them, right? So antitrust issues, both here and abroad. Europe is focusing in on Microsoft, Google, Apple on some of their policies and privacy and data collection issues. And in general, people are pushing back. Like, I mean, now when you go to anybody's website, right, you have to accept the cookies, or do you want the minimum cookies or all the cookies, right? You go somewhere. And so more and more regulation is coming down on them, which is going to increase their cost, increase their compliance to operate. And so they're going to cut employees that are not revenue generating or are less productive, which also brings us to the remote working world we've been talking about forever, right? Remote workers had about a 2-year run where, wow, productivity was up, everything looked great. But study after study is now proving, and these companies are agreeing, like Elon Musk we talked about, and I've talked about it, right? Hey, man, I don't think so. I think if you want to pretend to work, stay there, but if you want to work, come here, right? That type of thing. And we're seeing that action, and so they're taking action, and some of the remote employees are the ones that are getting cut in these jobs, Chip.
Well, you know who has joined you and Elon Musk in that view on remote work is Mark Zuckerberg. Actually, I'm going to hit you with a pair of headlines here, David, regarding Facebook. You know, it was 9,000 at Amazon. Meta, which of course Facebook is now known as Meta to lay off 10,000 more workers after initial cuts in November. Similar song to what we just sang about Amazon. But then Zuckerberg, also a CNBC headline, Mark Zuckerberg says Meta employees who work in person get more done. So in this era of layoffs, boy, make sure you're one of the people that's right there. Because as you've said, out of sight, out of mind, you're probably going to be the first one cut.
Well, and you got to understand is these guys are realizing with profit recession coming, who pays companies like these, right? Who pays a company like Meta, formerly known as Facebook, right? You typically don't pay if you're on a personal page and you're scrolling. So advertisers pay, businesses pay. We pay. I pay, right? We have ads out there on Facebook, I believe. I don't.
Right.
So we're paying somebody to place those ads, and so we're the consumer or the customer for these companies. And if we think they're less efficacious, if they're not getting as much bang for the buck, and digital advertising skyrocketed during COVID, it was where a lot of people started to spend their ad dollars. That's not near as effective, and so people are pulling those dollars away. So companies like this have to be prudent. They have a fiduciary responsibility to their shareholder to run their expense. In fact, in a recent SEC filing, Zuckerberg and Meta, basically they have to, this is in their what's called 10K, your quarterly filing. They said they're going to cut their expenses by up to $92 billion this year. $92 billion. Now, that's a lot more than 10,000 people's salaries. So are more cuts coming? Yeah, he just told you right there. So there's thousands more layoffs coming across the board in these companies, and it's going to spread, and other companies are going to. So the job market is going to shift right before our very eyes, Chip, and that is going to change the economy for the worse because more people are going to. I'm not employed. It's not as easy to go jump jobs as it once was, right? The job openings have started to shrink as well. We've lost over 1 million job openings since 3 months ago. And so we watched the Challenger Jobs Report and JOLTS. These are how many job openings are active in any one month, right? There was over 11 million a couple months ago. We're down to about 9 million job openings in America now. And that number's shrinking as these people get laid off. It's not as easy for them to go jump to a new employer. And so if they're unemployed, maybe they get some severance that they can hang on for a little while. But then they're going to have to tighten the belt. They're not going to be able to spend the money. And so that means less profit for maybe at their daily Starbucks. Maybe they don't buy that anymore, right? Well, maybe I can't buy that $280 pair of sneakers I really wanted or whatever it is, right? So you're going to see the ripple effects, again, back to that throwing the stone in the lake, and the ripple effects of something like this will spread out through the year. So you're paying more interest on your credit cards if you're using them. You're paying more dollars for to put gas in your car. You're paying higher interest on the car payment if you bought one. If you need to get a mortgage, you're paying a whole lot more today than you were a year ago if you had to get a mortgage in the last year or so, right? And you're paying more at the grocery store. All this, and you're going to start making less money. The wages are starting to come down as well. So again, not great news, and we're seeing real estate start to roll over as well.
So as someone who is not tech savvy, I have always presumed that if you are tech savvy, okay, you lose a job at Facebook or Meta or Amazon, but there's always a school, a business, somebody out there needs an IT person, that there's always going to be a job for you somewhere. But you're saying that's not the case, at least not right now.
No, exactly. And so there'll be some jobs, but there's not going to be, if we're playing musical chairs, we're taking chairs away from the table rather rapidly now. And so, if you had 10 people going around the chair, instead of pulling one chair away every 2 or 3 minutes, right, with the music playing, you're pulling about 5 away. You're pulling half of them away. And so you're going to see an acceleration of job cuts across multiple industries. We're seeing shifts in healthcare. Now, healthcare is one of the things, like, clients often ask us, hey, my kid's getting ready to go to college, not sure what he wants to study. Do you have any recommendations where you'd have a solid career, right? And so we always talk about, well, healthcare is, it's not 100% certain, but it's a pretty good bet that it's recession proof, right? We still go to the doctor when we're sick. You can, so healthcare has been a pretty good avenue for people that want to make sure they have stability in employment, right? So, and that's still to this day. My son is actually earning a bachelor's degree in a healthcare thing as we speak. And one of the things we talked about is exciting for him is he'll be employable in any city in America. And he's currently lives in Florida, but he's been talking, and him and his girlfriend are thinking, they might want to move somewhere else. And the great news is what he's getting his degree in, he'll pretty easily be employable. So, but when you come to the tech jobs, to your question, Chip, coders are almost always needed, but not maybe at the pay grade that some of them get. So companies like Google and Meta, they've been flush with cash. So some of these guys, and we have some of these clients, just so you know, so work for some of these and some of the bonuses and the stock grants they were giving were very generous, which is awesome. Companies shared the wealth. But they're not going to go from a job and make an X, and they're going to go now, and maybe their job might take them 6 months, and maybe they'll land a job paying Y. And people need to be realistic and understand, hey, if a job opens up, you might want to take it, even though it's not what you thought you would be getting paid.
David, in the time we have left, just a little offbeat number here. You sent me this story from Fox Business, and sometimes I start asking, am I reading The Onion? Am I reading the Babylon Bee? No, it was Fox Business. The headline is, J.P. Morgan Chase's nickel bags turned out to be full of stones. We're talking about, they thought they were buying the mineral, the natural resource, nickel. Some warehouse in Holland, in the Netherlands, is full of these bags that they thought had nickel in, and they were full of rocks. Is that what I read?
Yes, literally full of rocks. And
this is J.P. Morgan Chase. They don't make mistakes like this, do they? Obviously, I guess they do.
Well, it's funny, is I sent you this article, but there was a guy, I think it was on Twitter where I found it, actually. And Twitter is Trevor trove of just hilarious information, in my view. You got to take it with a grain of salt before you go out there. But I do find a lot of stories out there on this. But the gentleman that had posted this had a series, and I don't have them in front of me, of about 9 mistakes, worse than the one that he linked this article to, where JP Morgan, this big behemoth, you think it's a good risk managed company, and they make mistake after mistake after mistake because they don't have due diligence or processes in place, and they lose. We're not talking about losing a couple of bucks here. Oh, made a mistake and ordered the wrong printer cartridge, spent $80 I shouldn't. No, we're losing millions and millions and tens of millions of dollars, and this is just one of those type of stories. But it begs the question, when you're dealing with your finances, Chip, do you want to be with the biggest boy on the block, the big behemoth, big box store? Is it cookie cutter everything? Is that what they're presenting to you? Or do you want to work with a local, independent, fiduciary-based advisor that is going to be focused on your needs? Now, you don't necessarily maybe want to work with a one-man shop that's so small you're wondering, hey, will they be here tomorrow? And I think, that's what I get so excited. We have 10 advisors on the team, 10 licensed advisors on our team. We're almost the perfect size to serve our community here in Omaha and give people the type of advice I think they want. And we've developed this awesome proprietary smart planning process so that people can come in and just, try to give them the confidence that they know they're going to be okay. And not just when it comes to allocating their assets, Chip. We talk about this so much. The planning process is so much more. You got to understand, where's your income coming from? Do you have a written inflation-adjusted income plan? Do you understand all the medical and healthcare expenditures coming out of pocket? Do you have your legacy plans in place? Do you have a will, a trust? Have you updated? I mean, time and time again, people come in the office and we, greet them and say hello. Well, and we ask, hey, do you have a will? Well, yeah, we put it in place before the kids were born. How old are your kids? 34.
Right.
And so, these are things that we're going to address. Risk management's the R in that smart plan, and T, of course, our favorite thing, the tax-efficient planning. So I cannot encourage you enough. If you're just a little nervous of what's going on in the world, it's a great time to just get a second opinion. We will give you what we call a report card, which covers all 5 of those areas.
Well, let's take stock of everything we're offering you this week. So we have the inflation guide, of course, but then the report card, as David said, the comprehensive review of your entire situation. 402-369 7777 for that complimentary report card. And don't forget about the ABCs of Medicare. Now, it's also no charge, no obligation, but you do need to call to register. We need to know if you're coming. The ABCs of Medicare, that's Thursday night, March 30th at 6:30, right here in the Midwest Learning Center at Retire Smart. Dustin Galvin presenting. 402-369-7777. Call now to register for the ABCs of Medicare. 402-369-7777. David, bring us home.
Well, I don't know if there's a little snowflakes this weekend or whatever, but I swear I think spring might actually be here really soon.
The calendar says so.
I'm really
now,
excited.
if Mother Nature will just cooperate.
Yeah. Well, let's have an awesome and blessed April, and guys, take it easy. We'll talk to you next week.
Thank you for listening to Retire Smart with David Brooks. I'm Chip Maxwell. For David Brooks and the entire team at Retire Smart, have a great week.